Right. I think we have quite a people who have already joined. Hello, everyone. Now that we are live, I think we're almost right on time. So I believe we can begin. Okay, good afternoon, everyone. Thank you very much for joining us today. I am Oktay Kavrak, Head of Communications and Strategy here at LeverageShares. We are the issuer behind IncomeShares. And joining me today for the webinar is Jonathan Hobbs. He is our Senior Analyst. And before we get started, just a quick note that everything we discussed today obviously reflects our own views and opinions and is definitely not investment advice. And of course, no webinar is ever complete without the usual disclosures. So here's just a reminder that the views and statements are entirely our own and don't necessarily represent those of LeverageShares or any of its affiliates. So quickly, just to run through the agenda, this is the game plan for today. We're going to start with a quick overview of IncomeShares, basically for those that are not familiar, who we are and why we launched this platform. Then we're going to walk through the 3 different strategies that we use behind the products. So these are primarily covered calls, cash secured puts, and 0DTE put writing. After that, I just want to go through a few performance snapshots. So especially for those that are not familiar with the products, just to see how they've performed compared to the underlying instrument on which they've been created. And finally, we're going to wrap it up with a Q&A session. So please, as we go on with the webinar, put in your questions, and hopefully we'll be able to get to all of them by the entirety of the show. So about LeverageShares, especially for those that are less familiar with LeverageShares. We listed our first ETPs on the London Stock Exchange back in 2017. So that's when we pioneered this concept called single stock ETPs. It was basically a new category within the overall ETF space. When people think about ETFs, they instantly make a link with diversification. But ETFs and ETPs are just simply wrappers. So you can make as broad or as focused, you can get, I should say, as broad or as focused an exposure as you want using these kinds of instruments. And while leveraged offerings on indices existed in the past, no one had applied that approach to individual stocks. So that essentially became our specialty. By 2021, we'd expanded farther into, I should say, continental Europe. And by 22, we basically launched our white label platform. So that's where we allowed third-party asset managers to use our infrastructure and basically launch their own branded exchange-traded products. Then in 2023, our sister company launched the US ETF business. So that part of the LeverageShares family is more focused on thematic and leveraged single stock offerings. And since then, we've basically gone from niche to, I would say, mainstream, because nowadays we have some of the most traded exchange-traded products in London. And the one that takes the #1 slot currently is actually 3 times Tesla. And then, of course, in 2024, we launched IncomeShares. This is a dedicated sub-brand for options-based income ETPs. So while the product line is new, it's built on years of ETP infrastructure and trading experience. So in terms of the different business lines that we do or that we deal with at LeverageShares, IncomeShares is the newest, obviously, sub-brand, but it's just the 3rd bucket of exactly what we do. So the leveraged and inverse ETP business, that's where we have the widest range of single stock leverage offerings in Europe. The white label solutions, as I alluded to earlier, that's where we basically wrap and create products for third-party issuers. And then IncomeShares, it's the first time that European investors have access to options-based income ETPs on single stocks, on commodities, and even indices. So, the entire platform of IncomeShares was to basically democratize access to these options-based strategies, because we saw this, brand new category really taking off in the US, and we thought, it's about time that Europeans sort of level the playing field and have the same type of offerings that our overseas partners have had for some time now. So with that said, I just want to take a quick overview or have a quick look at the entire what we like to call the derivatives-based ETF space. So this is from a global perspective. It's one of the clearest trends of 2025. So it's this rapid rise of options income ETFs. So these are usually through covered calls or put writing to generate cash distributions. But these strategies basically exchange some upside potential for regular income. So it's a pretty simple idea that has become mainstream. And the sort of the approach is the same, but the way that it's achieved is very different across different issuers. So just to put some figures to it, in 2025 alone, these funds attracted nearly $50 billion of new money. So even as flows into traditional equity ETFs had slowed. And if you look at average yields, they're relatively high. So they're in the 20 to 25% range on a trailing, let's say, 12-month basis. But returns this year have basically been in line with the S&P 500. So they've been around 11% on a total return basis. So this entire options-based or outcome ETFs, it's by far, I would say, if not the fastest, one of the fastest growing segments in the entire ETF market. And if you look at some data that BlackRock and Morningstar put out recently, they're seeing this category grow year over year at a 62% rate, which has been even accelerating over the last few years. And these assets are projected to reach 650 billion by 2030. I mean, that is really hard to grasp, especially when you're talking about a category that did not exist 5 years ago. So this basically tells us that investors want defined outcome and these income-oriented exposures rather than just broad beta, which has been available to them until now. And while the US, actually not the US, I should say North American-based ETFs still hold about 85 to 90% of the AUM in these products, it's actually Europe that's growing a lot faster as more funds are being launched and as investor education has been improving. So what's the aim of IncomeShares? It's a pretty simple idea. I would say it's very straightforward. It's to generate monthly income from popular assets that everyone already likes to trade and hold, like Tesla, Nvidia, and gold, while maintaining exposure to their upside. It's a pretty simple three-step process. So obviously, first, we sell options on very well-known and liquid assets. Second, we collect the premiums from those options. And obviously, the last part is just distributing that income monthly to the end investor. So in essence, we're harnessing the volatility of assets that don't traditionally or haven't traditionally paid dividends, which basically allows investors to get exposure to those growth names, but at the same time, collect a monthly paycheck from having exposure to them. So the name is IncomeShares, and of course, income is the main story, but it's not the entire story. So make no mistake about it. The key goal, of course, is to pay consistent income, but there is a secondary objective, and that's to keep exposure to the underlying assets. So investors don't necessarily miss out on the upside. So historically, investors have had to choose between sort of like the three cornerstones of investing. You have growth, you have sort of some kind of protection, and you have the income-oriented strategies. Our approach is basically to try and bridge that gap. So it's not to chase the highest yield at all costs, but it's to find some kind of balance between income generation and also that potential for upside capture. Because especially when you look at our underlyings, we're talking about some of the, if not the most volatile or growth-oriented stocks in the world, they're absolutely among the top. So the appeal with these products, it can't be just yield. It also has to be some level of upside capture. So yeah, that's why on the slide you can see that IncomeShares, I would put them somewhere in between what you expect from growth stocks and what you would traditionally expect from dividend stock investing. Okay, so let's say you've made the decision to look into an options income product and you're sort of looking at the different types of products that exist out there. You really have to keep in mind that when investors choose that income-oriented product, you really have to understand how it generates income. And that's critical because there's so many ways and so many approaches that can be taken. Obviously, the first one is strike selection. So this is where you hear about terms like moneyness. So the these can be at the money, they can be in the money, they can be out of the money. So you really have to make sure you understand the differences. And of course, my colleague John will get a little bit into those, further on the presentation. You have to look at the roll frequency, because you can do rolls on a daily basis, you can do weeklies, you can do monthlies, and maybe even a further duration. So that's also one thing to look at. Then you have to look at the option types that are being traded. They can be on single stocks, they can be on indices, and they can be exchange traded, or they can be flex options. So have a look at what kind of options are being traded. And then there's this element of upside participation, which I think is absolutely essential, and I think everybody within the income investing community would agree, is that without a level of upside participation, the high level of yield that you're able to generate, I don't want to say becomes meaningless, but almost kind of defeats the purpose, because one without the other, I almost feel like is a subpar product. So that's also something that you really need to pay attention to. And then, of course, one of the last elements to look at is implementation. These products can be passive, meaning they just try to track an index that's already out there, or they can take a more active approach. So they can make it rules-based, they can implement any types of other kind of approaches. But the main difference is that they're not just trying to replicate an index that already exists. They're trying to, add their own element of sort of add their own twist, which they think will make the product perform better, or, meet its primary objective slightly better. And with that, I want to hand it over to John, who is going to dig deeper into how exactly our strategies here at IncomeShares works.
Yeah, well, thanks, Oktay, and hey, everyone. My name is John Hobbs. I've been at IncomeShares for a while now, and working with Oktay and moving forward with the different strategies. So basically, as Oktay was saying, there's two sides of this this equation. The one is you want to have some participation in the upside of the underlying assets. The other one is you want to generate regular income. So we have three different strategies that we currently use, and we essentially tailor those strategies based on the underlying assets. They all have the similar type of goal, but they all obviously are slightly different. So the covered call strategy is probably the most vanilla strategy we have, which is where you simply hold the underlying stock. So for example, gold, and then you'll sell call options on that exposure to generate income. So with this particular strategy, because you are selling the call options, you're effectively giving up stock in major rallies, which can mean that you might underperform to the upside in a major rally, but then in a in a more sideways market or a down market, perhaps you're generating income, which can, help smooth the overall general return profile. With cash secured put plus equity, this is the strategy we launched with our new single stock ETPs, and we do this now for our stocks. This is essentially, instead of selling call options to an income, you're selling put options. So here you're also holding cash, which is where the cash secured part comes in. So you have enough stock to actually buy the underlying asset if the puts get exercised. This aims to achieve the same goal. So it does track the underlying more closely with a single stock, for example. And then with the indexes, we have 0 days to expiration put rights, which is essentially very similar to the cash secured put plus equity, where we hold about 25% exposure to the underlying assets, and then we sell puts on it, except with the 0 days to expiration, they're obviously 0 days to expiration. So they are puts that we sell the same day that they are written. And if we just go into the next slide, I'll start to go into a bit more about that. So, with volatility is obviously a crucial thing when it comes to options. The more volatile the investments, you can typically generate higher options premiums, but then that obviously comes with greater downside risk. So what we try to do is tailor the strategy depending on essentially the risk profile of the assets. So for example, we are using a cash secured put plus equity strategy on the single stocks, and then on things like gold, we're doing covered call strategies. So if we just go to the next slide, I'll go a bit more into the covered call itself. So as I've mentioned, the most vanilla strategy that we have, and that's just to simply buy the assets or already own the assets and then sell call options on that asset with the aim of generating income. So a simple two-part strategy, and then moving on to the next slide, we can see the benefits of covered calls. So you are going to earn income from selling call options. That is one of the benefits. And then you do keep upside exposure to the underlying assets. But again, because of the way that the covered calls work, a call option is essentially the option to buy an asset if it reaches, or to buy the asset at the strike price. So if the price goes above that strike price, because we are the ETP, we are selling options. So we will then have to sell that option effectively, which can mean we get rid of the stock, which means that we don't participate in that extra upside. But on the flip side, we do reduce the downside risk because we always get the option premium from selling the call options. So that can help smooth the overall return profile. And just moving on to the next slide, I can show you what this looks like in different market scenarios. So you've got a bull market, bear market, and a flat or choppy market. As I mentioned, in the bull market, as we've seen with gold, for example, you might have slight underperformance due to giving away the stock. But then in a bear market, you're receiving the income, which can obviously help cushion downside risk. And then in a flat or choppy market, that is a really good environment typically for these kinds of strategies, because essentially the stock isn't moving much and you're basically being paid to wait and earning potential income as the stock price itself moves sideways. We can then see on the next slide a hockey stick diagram just to explain a bit of the theory. So the green line over here, you can see is the stock price, the stock only. And obviously that goes higher where there's covered call payoff. It gets capped if it goes above the strike price. And then if you look at the red line, which also moves into the green line above, there's that parallel gap. And that parallel gap is basically income premium you're receiving from selling the call options. So, it still will track the movement of the stock, but you get a buffer depending on where the stock is, whether the price is going up or down. And I think we'll move on to cash secured puts on the next slide. So the cash secured put plus equity strategy. So, this is the strategy we now use in our single stocks. And as I've mentioned, instead of selling call options here, we're just selling put options, and we're aiming to generate income from those puts. Here, there's two parts to the strategy. Essentially, there's holding the underlying stock. So 25% roughly we will hold, and that's just equity exposure. There's no cap on that like there's with a covered call. And then there's about 75%, which is in the options position, and we can hold cash where essentially if the stock price drops, we can then go in and we have enough cash to buy those put options when they get exercised. So that's the strategy. One of the things about this strategy is that if the stock price drops, if you are selling or buying if you're a put option buyer, that means you've got the option to sell the stock, which means we have to buy the stock. We will be buying the stock at the strike price. But because we're collecting income from the premiums, we're effectively you can get an effective discounted price if you factor in that income that you receive from the premiums into the general strategy. So next slide, we will look at the benefits. As I said, it's similar to a covered call in terms of the overall benefits. I'd say the main difference here is the upside is a little bit different. So for example, with a covered call strategy, on a single stock, those can rally quite a lot in one particular day on a news event or earnings announcements. Let's say Tesla, for example. If that stock rallies as a covered call, you might miss out on that rally because you get capped. Whereas with a cash secured puts, because a put option, if you're selling it, you don't have to sell stock if it breaches that price. So you actually still participate, but you do have a different kind of exposure. I guess 25% exposure on that. So it's just a slightly different profile to the upside. And we found that since moving to the new strategy, it tracks the underlying a lot better for single stocks. Then on the downside risk, it's the same thing. It reduces the premium can reduce the mitigate some of the losses. Bull market, again, similar to covered call, it's, you're not going to outperform potentially if the market is running, but in a bear market you get that income premium. A flat or choppy market, when the market's going sideways, again, you're getting paid to wait. So overall, it is a general kind of all-weather approach to investing, rather than sacrificing a little bit in the bull market, but getting overall gains over time is the goal. Next slide we'll look at is well, this is back to Oktay, I believe. He can just explain a bit more about the put rights themselves and how we do it in different legs.
Sure. Thanks a lot, John. I think when it comes to covered calls, most people have a pretty good understanding of how it works, because traditionally, since the launch of these kinds of products, covered call has been the strategy that's been used, it's been written about, it's been reported on, YouTubers have made videos on it, so I think there's a pretty good understanding around the covered calls. But since put rights seems to be slightly more confusing, I kind of wanted to dedicate a few slides to go into a little bit more detail into how exactly our strategy works using the put rights. And here we basically have three key components, or what I like to call legs. These work together to sort of balance that income and also some upside potential. So the first leg, shown here in orange, is that essentially shows the at-the-money put options that we're selling. So this portion, or this leg, is designed to maximize the extrinsic value capture. So that's the pure income component of this whole thing. So at this stage, there's almost no upside participation. It's all about that premium capture. Then we have the second leg, that's in blue. In this part, we're basically selling slightly in the money puts. And when we're talking about an in the money put, it's like an out of the money call option where you're able to capture some, in our, in this sense, weekly upside moves, because we're selling weekly options. So we're able to capture some of that upside move as well in the stock itself. And at the same time, we're also collecting additional option premiums. Not as much as the at the money calls, but there's still some extrinsic to be captured with the slightly in the money leg. So this adds a touch of growth potential without giving up that entire income foundation. And then the final element, which we like to call leg 3, which is in green, is that uncapped equity sleeve. So this portion of the strategy fully participates in the stock's move. So let's say if you take a stock like MicroStrategy or Palantir or Tesla, if the stock were to rally, we aim to have a 25% equity sleeve that's always going to fully participate in the upside move of that underlying instrument. So together, when you look at these three legs, they create a structure that aims to maximize that income, but you're also adding, I would say, a controlled upside exposure while still keeping part of the position open to that full equity participation. So I think this is the part that kind of confuses a lot of people. But just to give you a better sense of why we have the multiple legs and what the purpose of each one is, I think this layout here does a pretty decent job of showing what the aim is to do. And then I want to just express this using some numbers as well. So let's take an example looking at some obviously hypothetical figures. So let's say on a Monday morning, we were to sell an in-the-money put on a stock that's currently trading at $100. And let's say the strike was $105. So for that put sell, we're collecting $6 in premium. So if by later in that day, the underlying stock, which was trading at 100, now all of a sudden rises to 104, that option that we had sold for $6 has lost roughly 80% of its value. So now what we can do at the fund level is we can buy it back cheaper. We can buy it back for about $1.20. So when we do that, we've essentially realized or captured $4.80 of profit. After doing that, we're then immediately able to sell a new put at a higher strike for another $4.80 in premium. So if we look at it in totality, let's see what happens on Friday. So by Friday, if that new option were to expire worthless, we've earned a total premium of $9.60. So just compare that with the $6 that we would have made if not for the active management element of these strategies. And if we had this set and forget approach, right? That's a 60% difference in income generated. So this just shows you how the active rolling captures that extrinsic value in my view, slightly more efficiently. And then on the right-hand side, you sort of see the difference between intrinsic and extrinsic. So when you're selling in the money options, the premium includes two key components. So obviously that's the intrinsic and the extrinsic. The intrinsic here in blue, that's that built-in stock exposure. So that part stays inside the fund, and that's what contributes to the NAV. So this portion is not distributed. Even though it was part of the premiums collected, because it's intrinsic value, this part remains in the fund. Then when you look at extrinsic in orange, that's the time and volatility element. That's the premium for those two things. So as time passes, this part decays, and that's what becomes income ultimately distributed to investors at the end of the month. So the key takeaway is this: intrinsic stays in the fund, extrinsic, that's your distribution. So these are just some of the key elements that investors really have to, in my view, get a clear understanding of before being able to become comfortable with these put right strategies. Over to you, John.
Thanks, Oktay. So yeah, I mean, this is just a summary table of the different strategies we use and how they earn income, how their equity get equity exposure, upside potential, and also the different products it's related to. So as I've said, you know, the covered call, as Oktay's also said, is probably the most straightforward strategy, and we use that for gold, silver, and US Treasury bonds. These are our kind of macro assets, if you will. These have been working quite well with the current assets, and so we're sticking with those. The income strategy is essentially to sell call options. You do hold some shares, but you sell call options against it. So you do get the capped upside. If the stock price falls, you know, that can offset some of the losses. And then with the cash secured put plus equity strategy, the difference being we sell put options. You do hold shares, but you hold those shares separately as a 25% exposure, and then you have the cash secured put strategy, which can buy shares, essentially buying the dip. If the stock price falls again, you do get the income potential to help cushion the losses, and those are at the bottom, the different single stocks that we currently have the cash secured put plus equity strategy on. The 0 days to expiration put right strategy, it also holds an equity sleeve similar to the cash secured puts. The main difference being is that we sell put options that expire on the same day. And then that can actually work a bit better with the S&P 500 and the NASDAQ, where we use the SPY and QQQ ETFs to get that exposure. And then those are obviously not as volatile as the single stocks. So we found that the 0 days to expiration seems to be the right approach there. So that is the general summary of what we do. I think I'll hand over to Oktay now to go over some performance slides of the cash secured puts.
Perfect. Thanks a lot, John. So let's actually look at some actual hard figures so we can kind of see how these products actually move in tandem or in line with the actual security that they're trying to track. So here we have basically two charts showing different time periods, but showing the same three pieces of information. So the first chart on the left-hand side shows the performance of Tesla stock. Obviously, this is price performance. Tesla doesn't pay a dividend, so you don't have to worry about that. And then the line in seems to be red. That is the IncomeShares Tesla options ETP. So that's the total return. And total return is basically assuming that all dividends or distributions that were paid out are ultimately or reinvested back into the product. And the NAV line, which is that orange line that you see, shows the NAV, or what some people like to refer to as the price movement of the actual product. So here I think you can see a pretty clear understanding of how the product has moved over time. Since launch, then probably up until mid-2025, TSLI, which is our IncomeShares product, followed this traditional covered call strategy with a 100% overwrite. So naturally, this fully caps your upside. So you can see that lag in performance before July of this year, and that was mainly due to the restrictions from key counterparts like market makers. It could be listing venues, etc. But finally, at the start of July 2025, we were able to start implementing some of the changes that we wanted to see. So we switched from a covered call strategy to this cash secured put with an equity sleeve that we referred to slightly earlier. So that change shown by the dashed line on the left is when this strategy total return line started to outperform even Tesla stock itself. So the results after the change can be seen on the screenshot on the right. And the improvement basically came from, I would say, 3 key refinements. So we implemented a decay rule, which basically let us lock in option profits early and open new positions, sort of similar to that example I gave earlier. We also implemented a multi-strike model. So that's where we added this equity sleeve, allowing for even more upside participation in the underlying security. And then we also have the flexibility now to do dynamic strike selection. So based on the volatility of the underlying instrument, we're able to be a little bit more nimble around that strike selection. So together, these changes help that strategy capture a lot more of the upside while still generating what I think are very compelling yields. So just moving on to another example here. This is for our IncomeShares Magnificent 7 options ETP. It's more of I would say it's more of the same story because this product was launched in early July. You can see the performance figures here. So once again, that white line sort of shows the Magnificent 7 index's performance, and this is on a total return basis. So for those of you that are not familiar, Magnificent 7 is basically a basket of leading tech names, all of the names that I think we're all familiar with like the names of Apple, Tesla, Nvidia, etc. And then the line in red shows the total return of our IncomeShares Mag 7 options ETP. And then once again, the line in orange shows the performance after the distributions have been paid. So what you can see here is that on a total return basis, once again, it's outperformed the index that it's actually linked to. But even if you look at it at a price level, the price or the NAV has been increasing since being launched. So there's no NAV erosion or sort of like some of the things that investors are ultimately spooked with when it comes to these kinds of products. So I just want to show 2 examples where we use this cash secured put plus equity type of strategy on these underlying instruments that many investors are very interested in having exposure to. And now I'm going to pass it back to you, John.
Thanks, Oktay. So yeah, as Oktay mentioned, with the single stocks, the biggest improvement in moving to the cash secured put plus equity strategy is the NAV erosion has gone, and they're actually moving up the underlying themselves. So that's a really good thing. With the covered calls, we are still using them with gold and TLT. And if it's not broken, don't fix it. As you can see here, obviously gold has been on a monster rally for the last couple of years, really. But since we launched the gold plus yield ETP, it's gone up quite nicely with gold. If you look at the orange line, that is the NAV itself, GLDR, without the income. The red line above it is including the income, so the total return. And then as you can see, it's really tracking gold quite nicely. Obviously, gold's been in a bull run, so it has underperformed slightly, but doing what it says on the tin. The thinking is that if gold were to go into a more volatile period, trade sideways more, perhaps go a bit more to the downside, the options income would serve the strategy quite nicely and potentially lower the risk. So it would be essentially still keeping gold exposure, but maybe not with as much risk because of the income generation. And then the next slide, we'll move into TLT, which is long-dated US Treasury bonds, so Treasury bonds that mature in 20 years or more. So the ETF that holds them is TLT. Now, this is an interesting one. We do use the covered call strategy. TLT itself actually does pay income because the bonds pay coupons that are held in the ETF. So the way I like to think of the TLT product that we have, which sells call options on TLT, is it essentially is trying to track the general direction of TLT while paying a higher yield than TLT itself. So effectively it's a bond with maybe not as much upside on the price. The TLT is suppressed and it rallies from here, but the yield is obviously potentially higher because it's selling call options on TLT, as well as the yield the TLT pays. So that is quite an interesting one, in my opinion. I think that's the end of it now. We do have about 10 minutes now for Q&A. If you haven't written a question yet, I can't see any in there, but there is a box at the top that you should see on your screen called Q&A. If you want to write something in there, we'll give you a minute or two, and then Oktay and myself will try to answer those for you.
Absolutely. And yeah, in the meantime, for anyone that wants to maybe send over some questions via email, you can reach out to us at info@leverageshares.com, and also try to reach out to us on socials because we're actually quite active on platforms like X, LinkedIn, and multiple others. Actually, I do see one question in here. Let me try to pull this one up. Okay, so how are the distributions generated and are they guaranteed every month? Okay, so I think this is actually one of the more popular questions that we get probably in our inbox, and it's around the level of the distributions that kind of tend to vary month over month. And what people I think tend to forget is that these distributions are ultimately a function of the volatility of the underlying instrument. So let's take, I don't know, MicroStrategy or strategy as it's called right now. The volatility of that product was absolutely through the roof if you look at it, for the most part of 2024 and probably the earlier part of this year. And then what kind of happened over the last 6 months is the volatility, I would say, compared to its own historical terms, almost fell off a cliff. So it dropped a lot. So obviously, once the volatility of the underlying drops, the distributions linked to that ETP or ETF tend to drop as well. So the distributions, the levels of those distributions, I don't think anyone can guarantee them. But the way that we treat them is, multiple fund issuers, they have this target yield that they're trying to get to. It could be, let's say, 12%, 16%, 20% annually. And whatever, helps them meet that goal, they sort of distribute, and everything else they keep within the fund. At IncomeShares, all of the extrinsic premiums that we generate, we pay those out as distributions. So then it's up to the end investor to decide if they want to invest a portion, if not all of it, back into the fund, or maybe they just want to use that as passive income to live their life. So our philosophy is, pay out all the income we generate, at least currently, and then leave it to the end investor to decide if they want to reinvest any of those funds, any of those distributions back into any of our ETPs. No, I think we have a few questions. John, can you see them?
Yeah, I can see a few.
Okay.
Let's just go in the order. So from the bottom, we'll start.
Okay, go ahead.
What is the mechanism under which the number of outstanding shares in a particular ETP goes up or down?
Sure. Do you want me to take that one?
Yeah, I think so. You take that.
Sure. So the number of ETPs outstanding or shares outstanding is just a function of money flowing in and out of the fund itself. So let's say there was a creation, which is another way of saying, let's say $500,000 worth of new money coming into one of the products. So what happens is market makers come to us with that cash, and then we have to create new shares just so there's more shares on the market in circulation. So basically, shares outstanding is just a function of either money coming in or money coming out of our ETPs. So if the shares outstanding were to go down, that basically means that there was a redemption, meaning people were pulling money out of the funds. So let's say if a fund had an AUM of, let's say, 10 million, and all of a sudden it's at 9 million, that could be a function of people pulling money out of the fund. So that would be reflected in the shares outstanding. I hope that answered that question. Okay, I'll take the next one. So from Wayne, any hints on the new products coming this quarter? Good question. So I know people have been really asking about baskets. So that's something for me, and that's something that I've been pushing internally quite a lot. And we do have a few ideas that we're hoping to roll out before the end of this year. And of course, there will be more single stock names as well, just because once you've done something in the past, it's easier to do more of that. So we will launch more single stocks, but for sure, we're looking at baskets as well. And if you want to, if you need a clue in terms of around which topic or theme they will be. I think it's going to be around one of the most topical themes globally. The next one is, will this talk be uploaded to your YouTube channel for future reference? Yes, the answer is yes.
Yeah, we'll also be looking to build that out a bit more with some more education.
Absolutely.
Generally on these topics. Are you guys planning to do any portfolio ETPs? So I think that's in relation to Oktay's, previous answer. Yes, more baskets.
Yeah. So I think with leverage shares, unlike a lot of other issuers, people are really paying attention to, I don't want to say retail investors, I would say DIY investors, because in my view, a lot of retail investors are even more sophisticated than institutional investors in some cases. So everyone is paying attention to what retail wants and what retail is paying attention to now. But this is something that we've been doing ever since we launched the first leverage shares ETP. So that's why I want to keep this an open channel. So if people want to see new products, please reach out to us on social media via our email inbox. I know there's a few influencers that have been kind enough to sort of educate their communities around these products. So please, just reach out to us, and we want to know what you guys want to see more of. There's a question about, if put options are exercised for a prolonged period, the percentage of equity in the ETP will rise much above 25%. What happens then? We rebalance. If that percentage weighting goes, let's say, plus or minus 5% in either direction, so if it exceeds 30% or drops below 20%, we just rebalance it back to 25%. So that would mean, let's say if we were to get assigned on the individual stocks, we would just sell that portion of underlying stocks on which we were unsigned, write new puts, and then keep the equity sleeve at 25%. That's what we would do. Really helpful presentation. I was fortunate enough to invest in May, so I am happy with performance overall. I have tracked the performance since the new strategy, which is 110% better than the previous one. How do you feel about the relative performance of SPY-O and QQQO since the new strategy? I sold out of them and invested in the newer ETPs. Okay, first of all, thank you for the kind words. And I think I understand your question. And for those that may not be aware, SPY-O is our 0DTE options ETP linked to the S&P 500, and QQQO is the respective one linked to the NASDAQ 100. So those, because they're using 0DTE put options, there are multiple approaches we can take with those. So either we can make amendments to the existing strategy, or we can launch another version of NASDAQ linked strategies. So those could be combining elements of maybe doing a better job of tracking the underlying index and maybe paying out a slightly lower yield, or it can be something with even a slight element of leverage, right? There's many ways we can approach this. Just because these two index products have been, I would say, among our more popular products since launch, I don't want to alienate the investors that have been happy with them. So right now, we're not thinking of any particular changes to implement with these on these respective products, but that doesn't mean that we can't change them, right? So if sentiment, gets relatively bad, or if people would like to really see an updated version of these products, we always have open ears, and we're listening to what people are talking about. So we are open-minded about it. But we didn't prepare any figures on those particular products. But I think especially the SPY product has done a pretty decent job of tracking the underlying index on a total return basis. For the Qs, I'm not sure, but maybe for the next webinar we can use those as examples. Okay, let's see. John, do you want to take the next one? I don't.
The put income strategy, could you please expand on the scenario where you get assigned the stocks when the puts expire in the money? In particular, the case where the stock price falls and the puts are deep in the money. Okay, so yeah, good question. I think we have to, kind of take a step back and simplify it. So put is an option to sell a stock if the price goes below the strike price. So if you are the option seller, which is the ETP, when that put gets assigned, you then have to go and buy that stock. So if you're buying the stock when it's deep in the money, you're effectively, if it's below the strike price, you still have to buy the stock at that strike price, which means that you're buying it at a potentially higher price than the current market price. But because you have income generated from selling puts on, the shorter, the less in the money puts, you're effectively getting basically an effective discount on that, because that's factoring into the the purchase price, if that makes sense. I hope that answers your question. Oktay, anything to add on that?
I think one of the key elements to highlight is that the economic sort of result is the same as holding the underlying stock. So whether you're holding the stock and that stock is going down in price, or you're assigned a put where the strike price is higher, and then you have to pay out that difference between where the strike is and where the stock is currently trading, the economic impact is the same. Because the thing is, if we're assigned the stocks, we have to realize that loss just because we're getting the stock, and we have to sell them at the market price, which is obviously lower. But the economic impact is exactly the same. So whether you're doing it through a covered call or through put selling, the economic impact when the stock is going down is the same. And that's because with our products right now, we don't have an additional protective element. So what we can do in the future is buy some protective puts on the downside that will cushion some of the downside risk. But in exchange, you're giving up some of that those higher distribution numbers, right? So there's no free lunch in investing. So one is always coming at the expense of another. So if we do get demand for these products where there's an additional element of downside protection, we can think about products for those scenarios as well. I'll take the next one. So is there a product plan that takes the best performers from the Magic 7, maybe Magnificent 7, and uses them to create an ETP of, say, around 5 stocks? I mean, why not? Like, there's a universe of I don't know how many stocks, and nowadays there's even more ETFs than stocks out there. So you can slice and dice these in millions of ways, basically. But yeah, I mean, if you have any particular or specific ideas, drop us an email, let us know, and we'll certainly have a look at it. How do your products compare to products of other providers, Global X, YieldMax, in terms of distributions for the same holdings, index or single stock? I could have put performance figures in this presentation to compare our products to those of competitors, but I don't think it would do them justice, just because their products have been out there for a longer period, and even if ours have outperformed since they've been launched, I just think it's too small of a sample size in terms of how long of a performance exists for our products to be able to compare them head to head. I can say that having compared the same underlyings, there are many instances where our version of the product tended to do better. But until we have a longer period to look back at, I wouldn't really want to, speak on behalf of other issuers' products or adjust this question. But I mean, there's a lot of information out there. I think you can look at the different approaches and the performance of those different approaches. But I know Global X doesn't do any products around single stocks, whereas YieldMax does. So obviously that's one of the key differences. And also, I don't think Global X has any 0DTE products, at least in the US or Europe, that I am aware of, whereas I believe YieldMax has them in the US. John, you want to go?
Yeah, so we did the next one. Are you looking to launch on more exchanges in Europe? So we've recently launched on Euronext Amsterdam. We launched on Deutsche, Xetra earlier than that. So then we've obviously got LSE. I'm pretty sure it's in the pipeline that we will continue to try and launch in as many exchanges as we can, provided everything's okay from a regulatory perspective and everything like that.
Yeah, so I mean, you can now trade these in US dollars, you can trade them in euros, and you can trade them in pounds sterling. So if there's any exchanges that you would like to see these on in addition, if we are able to list them, we probably will. One of the exchanges that we still cannot list them on currently, I believe, is the Italian exchange for some regulatory reasons. But if you do want to trade them in euros, you can already trade them on Euronext Amsterdam, and as John said, on Xetra in Germany as well. John, I think we skipped one. What products are you looking at now? How about a WPay or Ulti-type option? I can say for sure we are looking at those products and we're paying attention. So hopefully in the coming months, we'll have some news for you guys. Us as investors most likely prefer stable yield, distributions, and NAV. That makes sense. From Stefano, I see a question or maybe a comment. Discovered that in Italy, the distribution are not taxable as dividend, but ETP have only capital gain tax. So very interesting. The distribution lower the average price of buying, so the tax is deferred in the future as more capital gains tax. I didn't know in advance, so nice surprise. Thank you. Okay.
So that's just on the the withholding tax in the US. I'm not sure if everyone knows, but because if you sell a dividend stock, that is considered income in the US. So technically, you would have to pay withholding tax on it. But with an option, if you're selling options, it's basically treated as a capital gain, any gains you make, because it's effectively a trading strategy. So they class it more as a capital gain, which is obviously good for offshore investors, as in us in Europe and the UK, with the withholding tax aspects of that. So that is another advantage of these types of strategies from a tax perspective.
Interesting. Yeah, and obviously this is not tax advice in any way, shape, or form, but one of the other issues when investors are trying to buy, let's say, US domiciled ETFs and they live outside of the US, is they're faced with this withholding tax. That's it's a tax that's taken out even before the distributions are paid out from I believe the issuers themselves. And one thing about Ireland domiciled ETPs like ours is that there is no withholding tax at source. So we pay out the full amount of the distributions that we receive. And then obviously it's up to the end investor to check their own local tax jurisdictions to see how things stand and basically make sure everything is aligned in their own jurisdiction. But at the fund level, there is no withholding tax with IncomeShares ETPs. Okay, if you're doing this for other people as you are, then you must all be very rich yourselves. That is a very kind comment. Gotta go. Great session. In a taxable account, are your distributions taxed as income or dividends? I wish I had more expertise on this topic, but I definitely don't know the answer to this. And I probably wouldn't be comfortable to answer even if I did. Thank you for your question. And I really hope they can find the answer to it online. Okay, I think we're running up on about an hour. So I think we had a great session. Thank you everyone for your great questions. And I think with that, we will wrap it up.
Yeah, thanks everyone. Great to do the presentation.